Good morning, ladies and gentlemen, and a very happy Memorial Day holiday to you. Let's very briefly run through everything that happened last week and what is likely to happen next week and why, because there are some puzzling developments. And also just another word of warning about the risk model at the moment. It basically went to risk off simply because of mathematics and the very erratic current behavior of XLU, the utilities sector, which is all to do with AI and the electricity consumption that AI is going to generate. I would really completely ignore the model at the moment because it went, as I said, to risk off purely through the mathematics of the moving averages. There is nothing really bearish going on at the moment in equities, and certainly not as an asset class compared to bonds. So I would completely ignore it at the moment, although I do think some more wiggles are likely here. It is not something which is important in the medium or long term. The bond curve keeps on flattening. Whatever I might believe or why I might believe it, I am wrong. It's as simple as that. If we look at what happened last week, basically all the action was 2s, 3s and 5s, which went up in yield, and the rest of the curve, 10s and 30s, basically did nothing. We do have a lot of auctions next week, 2s, 5s and 7s, over 180 billion, and I think the pressure is likely to remain there. The yield curve is basically going back to pricing the possibility that the new dot plots, which we get at the next meeting, FOMC, which is in the middle of next month, so another, 2.5 weeks to go, we are going to have the possibility of 0 cuts priced in for 2024. I think 0 is probably too soon and too much. I think there will still be 1 cut in there for 2024, but even that is enough to make the 2s out to 5s go up in yield, and certainly the possibility that it retests this area just above 5% is not negligible. But once there, I think that the 2s will be stuck and prevented from going higher, simply because it's extremely unlikely that the Fed needs to hike. The bar to hikes, I think, is impossibly high. It would involve a reacceleration of inflation. And I think that we are extremely unlikely to get that, given what commodity prices are doing, which is not a lot to the upside. Given that, I would have thought that any kind of 505 to 5 to 505 is going to be the ceiling for 2s because of the reinvestment risk. And from there on is the only possibility that I see for a steepening yield curve as supply keeps on hitting the long end. I just can't get bullish of bonds in general, but I really did think that the yield curve would steepen as a result of the supply, and it's not. So, wrong, rethink, wait for 505, 510 and retry at those levels. If we change to a weekly bar, we'll be able to see that the highest close actually was around the 510, 511 area in 2s. There is a possibility that we retouch it and everybody gets bearish, but I don't think it's going to happen before the FOMC. It can happen after the FOMC if it shows no cuts at all, and then really you're looking for 527 to be the top. But I just don't see that. I think that Powell is going to be able to hold the line and keep the hawks at bay, and really then this 505 area becomes the area that you want to be long of 2s, simply because if you do the maths and you have any cuts at all in 2025, this 510 area becomes very cheap for the very short end. And if we look at fives instead, I think that over the course of the next couple of weeks before the FOMC, the likelihood is that we trade this 468 area, but not much more. What is really surprising to me is that the 10s and the 30s are as well behaved as they are on a daily and weekly basis. I would have thought that 458, 459 is probably going to be as much as we can expect in the next couple of weeks. And in the 30s, this kind of 471, 472 area is going to be all that we can get before the FOMC. I think the pressure is still on the bonds. I don't see any reason why the bonds should do better. It's very unlikely that the economic figures turn. They haven't. Every time we get any weakness, the weeks after data, like in unemployment claim, denies the previous week. And therefore, I think that the pressure has to remain towards the upside in yields. It's just that the yield curve is flattening because they think that this is 2s, 5s, and we had like 4 weeks of flattening now, because they think it's just a question of when they start cutting and not if they start cutting. So once the 2s are at their target and they can't move any further up without starting discounting no cuts at all, that is when we can start steepening again. Until then, we are likely to remain in this, going towards the upper band of the flattening. So 2s, 10s, I really don't see how they can go above 53 until the Fed, but the pressure is in that direction. And 5s, 30s as well, we have the pressure now towards 0. And it's just going to remain constant because the supply they've engineered is geared towards the shorter end, i.e. next week we have 2s, 5s and 7s. And the supply, as you've seen from the QRA, they've maintained the 30s, the 20s and the 30s constant, and the increases are all at the short end. And I think that is having an effect and causing the flattening. I think, unfortunately, that we will not see a steepening or the possibility of a real steepening until 2s are at this target, around the 505 to 510 area, when after that, I think pushing 2s is going to be like trying to push a ball underwater. It'll just do something like this, and every week it's going to close around the 510, even though it might have gone higher. But from then on, any weakness really is all expressed in 2s. In Germany, we are rushing now towards the ECB meeting, and I would be shocked if they didn't cut at this ECB meeting, simply because they've telegraphed it so strongly. And yet not even the 2s can do much better, and the curve is slightly flattening there as well. So what do I think about the Schatz? I think it's extremely, extremely unlikely that we go above these levels here, which is like 314, 315, because if we do, and we do get a cut, then what are we looking for from the ECB? We're looking for no further cuts for almost the next 2 years. And I think that is extremely unlikely. I think once the Schatz reaches these kinds of levels, 317, 318, that is probably all that we can expect. And then all the danger is that we turn and we go back towards the 260s any time that we get any kind of numbers which indicate that the economy is not doing great. So let's have a look at the yield curve there. We have 2s, 5s, which are basically in a very tight range, but just like in the US, it's been flattening for the past 4 weeks. 2s, 10s, same kind of story. 2s, 30s, same story. So we're getting the same pattern in both the US and the EU. I would have thought that this, in the EU, it should start steepening before the US. Once the 2s are at their target, I find it very difficult to believe that we can then look for anything other than steepening there as well. I just can't see it. So I will be looking to put on steepeners both in the US and in the EU when the SHAT and the 2-year note are at the targets that I've just indicated. This is a chart of the 2-year in Germany against the 2-year in Japan. And everyone's making a lot about how Japanese rates are going higher. But as you can see, actually, EU rates are going up more. We have 15 weekly bars above this 253 area. So to me, going and trying to look for a top in euro yen before we start breaking down below this 253 area in 2s, or below this 184 area in 5s, or closing substantially below 150 in 10s is really pointless. We have very good triggers for those levels, and until those triggers are probably all triggered, the likelihood is that the differential between the euro and the yen is just so high that people just keep on buying euro yen blindly. And it's only when these levels break that you could get a sizable move in euro yen, especially if then the Japanese intervene on top. If I was running the Ministry of Finance in Japan, I would wait for these triggers to trigger, and then come in with a very sizable intervention, which could drive the price even 10%. But until that happens, I think the likelihood is that euro yen is not tradable to the downside. The differentials between the euro and the dollar are just really doing nothing. In fact, they've moved 2 or 3 basis points in favor of the euro. So it's really not surprising that DXY has done very little last week, gone up slightly, but that's about it. I don't think that this is going to be a mover in the next week. I don't think we have any signals to come from this. I think it's more likely to keep on ranging between 108 and 109 rather than do anything spectacular. I just can't see it, because the bond spreads are not doing anything and they're not indicating that anything is going to happen. For us to start breaking this 109 area, I think it would take a very bearish set of circumstances for bonds, and I don't think that we are getting them at the moment. The other thing that surprised me last week was gold. I was completely wrong. I thought it would stop in this 250, high 250s, 260 area, but it broke down through it, and really on Friday I expected to see a push back up to close this gap, let's say towards 23.90, and we didn't get it. To me, that this is beginning to be bearish behavior, and I can't understand why. The bonds are extremely well behaved, the dollar is extremely well behaved. I just don't understand what is going on here. But now the danger becomes a move down towards this 2270, 2260 area to just absolutely stop everyone out and say that this is a double top around the 2450 area. I don't think it will be a double top, but I think we can easily come down and do a stop out of people at some stage. To me, gold is still going to be bullish, and I'll show you why on some spread charts. This is a weekly chart going all the way back to 2010, and this was the previous high in gold versus TLT with dividends. And we bust through it, as you can see, in February and got very overbought. I think a retracement down to this kind of level is going to be very telling as to what gold does when it happens. And that would, by my calculations, assuming that TLT has not moved very much, which is the likelihood, that would be around the 2250 to 2230 area in gold. So that is the kind of area that I'm now looking at. I am slightly long of gold, and I'll probably bail it out on Monday, or Tuesday rather, simply because I don't see that the upside is that huge. But once we get down to these levels against TLT, I think that the likelihood is that the primary story of gold's strength at the moment re-emerges, which is the Chinese. If they're not going to be buying TLT, this would be a great area for them to start back in. And if I was the Chinese, that's what I'd be doing. I'd be buying around this 230 level against TLT. And that is the area where everybody would be getting bearish gold, because they said, oh, it's broken down. And yet I think that is probably the ideal area to come in and buy it. And DBC was also very disappointing, and I got that one as well completely wrong. So last week was a complete disaster. Not only did it not go up towards 2439, but it's in danger of breaking this 2307 area. And that would probably return it towards the lows of the year. And, very unlikely to me that it breaks 2175. Extremely unlikely. But what it does, it just gives you more, sideways action between this 2380 area and this, let's call it whatever this is, 2229 area. So it gives you more sideways action, which unfortunately says that bonds are not going to be in a trend. If commodities now started breaking down hard, I think bonds would go in trend. And because the Fed could easily cut 100, 150, 200 basis points, because we would be getting, in effect, deflation. But that isn't happening. But on the other hand, commodities are not pushing up higher, so there is no real pressure on duration apart from the supply. And that obviously at the moment isn't enough. It is what it is. I'm wrong. Obviously, even the pressure on bonds is not going to be as great as I think, and that in part explains the fact that the yield curve is flattening as opposed to steepening. It is what it is. I keep on getting this wrong. There is no inflation at the moment. We have got all these bars being contained, and if we even look at oil, what do we see? We see a constant trading between 80 and 77 or 76, and that is just not bullish enough. All the danger now is coming to the downside with these moving averages rolling over. Unless something big happens in the oil market, DBC is not going up, and that gives us the stability that the Fed seeks to cut at some later stage. And really the commodity sector and the way it's behaving is something which tells me that the likelihood of us going to no cuts in 2023 in the dot plots is very, very low. And therefore, if the 2-year get to that 5%, 505, I think the risk reward is enormous to be long of them there. Equities had a very interesting week, and actually you would have thought that nothing happened in equities, but we had some very deep rotation, and Nvidia was the culprit. This is the only thing I got right last week, that we would bounce off this 52.62, 52.55 area, and we did. But I don't think that we are done with the downside, simply because Nvidia can't keep on going up forever. And when it stops going up, the weakness that is inherent in equities at these levels, because the multipliers are so high, and unless bonds start going down, equities are really running on very, very thin air. If you look at the weekly, we closed basically exactly the same place that we opened the week, so you would have thought nothing at all happened. But if you look at the transports, and this is a weekly chart of the transports, or if you look at the industrials, that's the Dow Jones, a lot happened last week. Those got sold very, very heavily, and I think that's probably why bonds couldn't go any higher in yield last week at the long end. Really, it's all about Nvidia. And how much it is to do with Nvidia is shown by the fact that the Nasdaq couldn't even come back to the equivalent level of the 52.55 to 52.62, which would be 18,456, call it 18,450. And straight up it bounced the next day. Unfortunately, it's right up against the weekly Bollinger Bands, so I think the likelihood of NQ being able to drag everything higher next week is not particularly high. You know, it can drag it up a little bit, but not that much. What will be interesting again next week is, if we go back to my clean chart, is to see if this area, which I will now enlarge, to see if this 52.55 area gets retested and whether it gets broken. I think that a daily break, a close below that line, is what is needed to give us the push back down towards 51.80, and then maybe we can reload. But it's all to do with tech, and basically as long as the technology sector leads, I don't think that we can go down very far, because I don't think bonds are going to pressurize us enough. I just can't see any alternative to equities over bonds. This is NDQ over DJI, so it's two ETFs. We have broken substantially the previous high from 2021, and it just shows me that, you know, with wiggles, that is in trend. We are now looking for the Nasdaq for leadership, continued leadership, and even if we look for SPY over XLK, we will see that we are returning to the very, very lowest points, and that these are the sectors that will lead. Technology is in a phase of leadership, I think. So as long as technology doesn't completely break down and keeps on holding levels, the Dow isn't going to go down a million miles. And therefore that to me indicates further stability in the SPX, which is like a composite of it all. And that gives me the idea that even if we do break the last week's lows, the low is 2-3 percentage points lower, something that we can trade, but not something that we would remain short over. To me, there is very little likelihood now that technology turns around on a sixpence and becomes weak. What I think is far more likely is that at some stage, the leaders, the very big mega cap stocks, like Nvidia, like Microsoft, have a bit of a rest and retrace 2-3%. And that should be enough to give the SPX room to break that lower level and do some kind of an ABC retracement with just below 5200 as the kind of low that you're looking for, maybe 5150. So that, I think, is as far as I think equities can go, unless they start really getting pressured by bonds, and certainly I can't see that happening next week. Europe, Japan, emerging markets, none of them are leading at the moment. As you can see, Europe is basically stuck, and also the Nikkei is stuck and looks far more likely to test down, levels which are below here, just to stop everyone out rather than keep on going higher. It did nothing on the week. It just showing none of these markets, including EEM, are now showing any kind of impulsion. And therefore, I think sideways to down is far more likely in those markets. And that is the mirror of what I think is going to happen in the US, with technology remaining relatively strong and not allowing SPX to be too weak. I've changed the support and resistance levels. All I'm really hoping for is that we see the 2-year note around these levels so I can finally get long of them and start looking to put in a decent sized steepener, because I really do think that at those levels the 2-year notes are really cheap and they won't be able to push them any higher in yield. And that is when the steepening can take place. It's not guaranteed, but it's when it can take place, because any kind of weak data then guarantees a steepening. As far as equities are concerned, I think this 52-55 area in SPX is going to be absolutely crucial. And if we get a close below there, you will get pressure down towards 5180, but that's as far as I think it's possible, and I would be a very big buyer of calls from that level. So looking to job it to the downside, and NDX will really tell me when it's time, because if you can't even get to 18,450 and test that level, and first time round I really doubt it's going to break 18,450, a close below there becomes the signal that this kind of level is allowed in SPX. Without it, I don't think it's possible. That's really all I've got for you. I think it's going to be a quiet week again as we digest the auctions and we prepare for the FOMC and the ECB. And let's hope that it's slightly more profitable than last week. Thank you very much indeed, and have a lovely Memorial Day weekend, and tweet you on Monday.